Chapter 1. The Secret Name of Profit. Every market has two faces. One face is public, bright, and ceremonial: charts, prices, news, indices, earnings calls, central banks, and confident voices on financial television. The other face is hidden in the machinery. Why one investor earns more than another after taking risk, waiting longer, knowing more, moving faster, or understanding human weakness better. That hidden face is called alpha. In simple words, alpha is the return that cannot be explained merely by riding the market. It is the extra shadow on the wall, the additional flame above the common fire, the part of performance that seems to say, someone here saw something before others did. But alpha is never just profit. Profit can come from luck, leverage, inflation, or a rising tide that lifts every boat. Alpha asks a more dangerous question. What was the source of the edge, and why did the market allow it to exist? The logic of extracting profit is therefore a map of invisible springs. Some springs come from risk that others refuse to bear. Some come from human fear and greed. Some come from slow institutions, forced sellers, regulation, liquidity shortages, information delays, or machines reading the market faster than people can blink. The story of alpha is not the story of one formula. It is the story of hunters, monks, gamblers, mathematicians, merchants, professors, and machines trying to hear music inside noise. And every source of alpha has its own mythology, its own heroes, its own disasters, and its own graveyard. Chapter 2. Before alpha had a name. Long before modern finance invented elegant words, merchants already understood the first law of profit: buy where something is ignored, sell where it is desired. In ancient ports, information traveled with ships, rumors, spices, coins, weather, and war. A merchant who knew that grain was scarce in one city and abundant in another held a primitive form of alpha in his hands. The Dutch Republic turned this instinct into architecture. In the 17th century, Amsterdam became a theater of contracts, shares, voyages, and speculation. The Dutch East India Company was not merely a company, it was a floating empire divided into pieces of paper that ordinary citizens could buy and sell. The same century gave finance one of its first cautionary legends: tulip mania. A flower became a symbol of desire, scarcity, taste, status, and madness. The tulip bulb was not only a plant, it became a dream compressed into a contract. Then came the grand bubbles of 1720, when Britain's South Sea Company and France's Mississippi Scheme turned national hope into financial fever. John Law, the Scottish gambler and financier, imagined that credit could transform a state, while London speculators imagined South American riches that were more fantasy than cash flow. The crowd believed because the story was beautiful, and beautiful stories are among the oldest alpha sources in history. These early markets showed that profit is not born only from numbers. It is born from distance, scarcity, emotion, narrative, and delay. Before alpha had a name, it already lived in ships arriving late, letters carried across oceans, and crowds willing to pay for a future they had not examined. Chapter 3. The Birth of Risk as a Science. For centuries, investors spoke of risk as sailors spoke of storms. They feared it, respected it, sometimes ignored it, but rarely measured it with discipline. Then the 20th century brought mathematics into the temple, and Harry Markowitz began to describe portfolios not as collections of favorite assets, but as living systems of return, variance, and correlation. This was a revolution in tone. The old investor asked, "Which stock is good?" The new investor asked, "How does this asset change the behavior of the whole portfolio?" It was like replacing a treasure map with a weather model. William Sharpe then helped formalize the idea that the market itself carried a kind of price for risk. The capital asset pricing model suggested that some return was not genius at all, but compensation for bearing market exposure. Suddenly, alpha became clearer because beta had been named. This mattered because many investors who believed they were brilliant were merely riding a strong market. A rising tide can make every captain look gifted. But once finance separated market exposure from excess performance, the romance became colder and more precise. Alpha, from that moment, had to defend itself. It had to prove that it was not just courage, not just leverage, not just being in the right decade. It had to step into the laboratory and survive measurement. Chapter 4. Efficient Markets and the Heresy of Outperformance. Eugene Fama entered financial history like a severe judge. His efficient market hypothesis argued that prices rapidly incorporate available information, making short-term prediction extremely difficult. In this view, the market is not a sleepy beast waiting to be fooled. It is a nervous creature that absorbs news almost instantly. This was almost insulting to the old mythology of the heroic stock picker. If markets are efficient, then the investor is not a knight finding hidden treasure, but one more traveler in a crowded city where every sign has already been read. Alpha becomes rare, suspicious, and temporary. Yet the efficient market idea did not kill the search for alpha. It sharpened it. If the obvious opportunities disappear quickly, then the surviving sources must be deeper, stranger, or harder to harvest. This created one of the great dramas of modern investing. On one side stood the priests of efficiency, saying that most investors should accept the market return. On the other side stood the heretics, saying that patterns, behavior, institutions, and frictions still left cracks in the wall. The argument never fully ended. It became the engine of modern investment culture. Every alpha source is, in some way, a rebellion against the sentence. The market already knows. Chapter 5. Risk Premia, being paid to carry the weight. The first source of alpha often does not look like cleverness. It looks like endurance. Some strategies earn money because they accept a burden that other investors avoid: volatility, illiquidity, credit risk, duration risk, crash risk, or the pain of looking wrong for years. This is the world of risk premia. The investor is paid not because he found a secret, but because he agreed to carry a heavy object through dangerous terrain. Insurance companies, banks, pension funds, hedge funds, and sovereign wealth funds all live somewhere inside this exchange between risk and compensation. Carry strategies are one of the classic examples. They often involve earning a yield or spread while hoping that the quiet road does not suddenly collapse. The trade can feel like collecting coins on a frozen river, calm, repetitive, almost boring, until the ice breaks. History loves to punish investors who confuse risk premium with free money. Before many crises, a trade looks stable because the danger has not arrived yet. Then volatility wakes up, liquidity vanishes, and yesterday's steady income becomes today's trapdoor. The romance of risk premia is therefore stoic, not glamorous. It is the romance of the guard standing in winter, paid because others prefer warm rooms. The profit comes from bearing discomfort, but the tragedy begins when the guard forgets that winter can become a blizzard. Chapter 6. Value. Buying the unloved. Value investing is one of the oldest moral stories in finance. It says that the market, like society, often rejects what is unfashionable too quickly. A company may be wounded, boring, neglected, or unfashionable, yet still possess assets, cash flows, or resilience that the crowd refuses to see. Benjamin Graham gave this idea its classical language. He taught that the investor should seek a margin of safety, as if buying a bridge strong enough to survive more weight than expected. His student Warren Buffett later transformed value from a bargain-hunting discipline into a philosophy of durable businesses, patient ownership, and rational temperament. The alpha source here is mispricing caused by neglect, fear, and impatience. People love glamorous growth stories because they resemble youth, speed, and destiny. Value often resembles an old factory at the edge of town, dusty, underpraised, but still producing. Yet value is not simply buying something cheap. Cheap things can be cheap for good reasons. The value investor must distinguish between a sleeping prince and a corpse with good accounting ratios. This gives value investing its literary quality. It is a discipline of second sight. It asks whether the crowd has mistaken ugliness for death and whether patience can become a form of rebellion. Chapter 7. Momentum. Following the fire. Momentum is the opposite romance. Where value walks into abandoned houses with a lantern, momentum runs toward the city already burning with attention. It says that assets that have been rising often continue rising for a time, and assets that have been falling often continue falling. This idea feels strange because it contradicts the instinct to search for bargains. Yet markets are social machines, and social machines move in waves. News spreads slowly, institutions adjust gradually, analysts revise forecasts in steps, and crowds imitate what appears to be working. Narasimhan Jagadish and Sheridan Titman gave academic force to the modern momentum discussion in the early 1990s. Their work showed that buying past winners and selling past losers had historically generated significant returns over certain horizons. Suddenly, trend and reputation entered the courtroom with data as their witness. Momentum has appeared in many costumes. It lives in equities, commodities, currencies, sectors, and even narratives. It is the reason people chase hot technology stocks, fashionable countries, popular funds, and assets that seem blessed by destiny. But momentum is a beautiful animal with sharp teeth. It works until reversal arrives. The investor who follows fire must know that flames illuminate the road and also consume the house. Chapter 8: Quality, the Quiet Aristocracy. Quality investing is the search for companies that do not merely survive, but breathe with composure. These are businesses with strong profitability, healthy balance sheets, disciplined management, durable competitive advantages, or high returns on capital. They may not always be cheap, but they possess a kind of financial nobility. The alpha source in quality comes from underestimating endurance. Markets often become obsessed with speed, disruption, and immediate excitement. Yet the quiet company that compounds steadily can defeat the noisy miracle that burns through capital. In everyday life, quality is easy to understand. A cheap umbrella that breaks in the first storm is not cheap. A sturdy one that lasts 5 years may be the better bargain, even if it looked expensive on the shelf. In markets, quality became especially important as investors learned to separate accounting beauty from economic strength. A business can report growth and still be fragile. Another can grow slowly and still be nearly impossible to kill. The romance of quality is not the romance of conquest. It is the romance of the old house that remains standing after every season. Its alpha comes from durability, and durability is often invisible until the storm arrives. Chapter 9: Size, neglect, and the small cap frontier. Small companies occupy the frontier of public markets. They are often less researched, less liquid, less understood, and more vulnerable to disappointment. But precisely because fewer eyes watch them, they may contain opportunities that large companies no longer offer. The size effect became part of the academic conversation because smaller companies historically appeared to deliver different return patterns than large firms. Fama and French later made size one of the famous factors in their three-factor model, alongside market exposure and value. This turned smallness from a market curiosity into a formal source of return analysis. Small-cap investing has the atmosphere of frontier travel. The roads are rougher, the maps less complete, and the villages farther apart. A careful investor may find a business before institutions are large enough or willing enough to own it. But the frontier also contains mirages. Small companies can be fragile, poorly governed, dependent on one product, one founder, one bank, or one optimistic story. The same darkness that hides opportunity can also hide danger. The alpha source here is neglect. When the crowd is busy admiring palaces, someone may find value in the workshop. Yet the workshop must be real, not merely a painted door in the dust. Chapter 10: Behavioral Alpha, the market as a human animal. Behavioral alpha begins with a simple insult to human pride. Investors are not perfectly rational. They panic, overreact, underreact, anchor to old prices, follow crowds, hate losses more than they love gains, and confuse recent experience with permanent truth. The market is not only a calculator, it is a crowd with a pulse. This idea gained strength through behavioral finance, where scholars like Daniel Kahneman, Amos Tversky, Robert Shiller, Richard Thaler, and others explored the psychological architecture of judgment, bubbles, and mispricing. Their work helped explain why markets can become euphoric or terrified, even when the spreadsheet has not changed as much as the price. Alpha in this world comes from understanding the weakness of the observer. Everyday life gives the same lesson. A person buys an expensive coat because others admire it, not because winter requires it. Later, the same person refuses to sell an unused object because accepting a loss feels like admitting defeat. Markets magnify these habits with money, status, and public scoreboards. A falling stock becomes not only a financial loss, but a wound to identity. A rising stock becomes not only a gain, but proof of intelligence. Behavioral alpha is therefore psychological archaeology. It digs beneath the price to find fear, envy, pride, shame, and imitation. The investor does not merely ask what the asset is worth. He asks what emotion is currently wearing the crown. Chapter 11: Information Alpha, the race to know first. Information has always been a weapon in markets. In the age of sail, knowing that a ship had arrived safely could be worth a fortune. In the age of telegraphs, cables, satellites, terminals, and APIs, the race became faster, colder, and more technical. Legal information alpha comes from processing public or properly obtained information better than others. It may involve reading filings, understanding supply chains, interpreting satellite imagery, detecting pricing changes, or seeing patterns across industries before the consensus forms. The edge is not merely knowing a fact, but understanding its significance. Illegal information is a different matter entirely. Insider trading scandals show the dark version of the same hunger, the desire to possess tomorrow's price before the public has today's truth. Those stories are dramatic because they reveal how quickly intelligence can decay into corruption. Modern markets have made information both abundant and exhausting. Everyone has news, but not everyone has interpretation. The scarce thing is no longer data alone. It is judgment under overload. Information alpha has the romance of spies and librarians at once. It belongs to the person who reads the footnote, notices the delay, hears the change in tone, and understands that one small fact has changed the whole map. Chapter 12. Structural Alpha, Rules, Constraints, and Forced Hands. Some alpha does not come from being smarter than another investor. It comes from understanding that the other investor is constrained. A pension fund may have rules. An index fund must follow an index. A bank may need to reduce risk. A mutual fund may face redemptions. A regulator may force behavior. Structural alpha lives in these forced movements. When someone must buy or sell for reasons unrelated to value, another investor may step in. The market becomes less like a debate and more like a crowded railway station where some passengers have tickets they cannot change. Index rebalancing is a simple example. When a company enters or leaves an index, certain funds may need to adjust positions. The event may create temporary pressure that has little to do with the company's soul. Distressed debt offers a more dramatic version. Some investors are forbidden or unwilling to hold securities after a downgrade, default, or restructuring. Specialists enter the ruins, examine the legal documents, and ask whether the broken building contains recoverable stone. The alpha source here is compulsion. One person's rule becomes another person's opportunity. The tragedy is that structural alpha often appears exactly when the air smells of panic. Chapter 13. Liquidity Alpha, the price of finding an exit. Liquidity is the ability to trade without moving the price too much. It sounds technical, but emotionally it is simple. Can you leave the room when the fire alarm rings? In calm markets, liquidity is taken for granted. In crisis, it becomes oxygen. Liquidity alpha comes from providing or demanding liquidity at the right time. Market makers, dealers, arbitrageurs, and patient investors may earn compensation for standing ready when others need to trade. They are paid for being the doorway when the crowd wants out. But liquidity is treacherous because it can vanish exactly when needed. Assets that traded smoothly yesterday can become frozen today. The screen may still show a price, but the price may be a ghost. The 2008 financial crisis taught many investors that liquidity is not a constant property. It is a social agreement that can break under fear. When trust disappears, even sophisticated securities can become stones in the pocket. The romance of liquidity alpha is urban and nocturnal. It belongs to the dealer under fluorescent light, the trader watching depth vanish, the patient buyer waiting as frightened sellers knock on every door. In that moment, liquidity is not convenience, it is survival. Chapter 14. Arbitrage, the dream of perfect symmetry. Arbitrage is the dream of finding the same thing priced differently in two places. In its pure form, it feels almost magical. Buy cheap here, sell expensive there, capture the gap, and bow to mathematics. It is the cleanest myth in finance because it seems to promise profit without prophecy. But true arbitrage is rare and quickly hunted. More often, investors practice relative value. Two securities are similar, historically linked, or economically connected, yet temporarily mispriced. The trade is not riskless. It is a bet that the relationship will heal. Long-term capital management became the legendary cautionary tale of this world. Founded by John Meriwether and staffed with extraordinary financial talent, including Nobel laureates Myron Scholes and Robert Merton, the fund pursued sophisticated relative value trades with heavy leverage. In 1998, market stress turned elegant convergence into terrifying divergence. The lesson was brutal. A spread can be theoretically wrong and still move further against you. The market can remain disorderly longer than a leveraged investor can remain alive. Arbitrage has the romance of geometry, but the danger of human time. Lines may converge on paper, but investors bleed in days, weeks, and margin calls. The perfect triangle becomes a trap when the world refuses to close the angle. Chapter 15. Event-Driven Alpha. Profit around the turning point. Event-driven investing watches the moments when a company's life changes shape. Mergers, acquisitions, bankruptcies, spin-offs, restructurings, lawsuits, regulatory decisions, and activist campaigns can all create temporary confusion. The alpha source is the gap between the old identity and the new one. Merger arbitrage is one of the classic examples. An acquirer announces a deal, the target stock moves, and investors estimate the probability that the transaction will close. The trade is part finance, part law, part politics, and part psychology. Bankruptcy investing is darker. A company enters court like a wounded kingdom, and creditors fight over the remaining land. Specialists read capital structures the way historians read dynastic claims. Spin-offs create another kind of opportunity. A parent company separates a business, and many investors ignore the child because it is too small, too strange, or no longer fits their mandate. In that neglected beginning, some investors search for mispricing. Event-driven alpha has the rhythm of theater. Before the event, characters are trapped in old roles. After the event, the stage has changed, and the investor who understood the script early may stand in the right place when the curtain rises. Chapter 16. Macro Alpha, Empires, Rates, Currencies, and Weather. Macro investing is finance at the scale of empire. It studies interest rates, currencies, inflation, commodities, deficits, wars, central banks, elections, trade routes, energy shocks, and demographic tides. The alpha source is the ability to connect the movement of nations to the movement of prices. George Soros became one of the symbolic figures of macro investing after his famous bet against the British pound in 1992. That episode entered market folklore because it felt like a duel between a trader and a central bank. Whether one admires or criticizes it, the story shows how macro trades can turn policy pressure into financial drama. Macro alpha is difficult because the world does not speak in one language. Oil may answer to geology, diplomacy, shipping, technology, and war. Currencies may answer to interest rates, politics, capital flows, and trust. Everyday people live inside macro without naming it. A family feels inflation at the grocery store. A tourist feels currency movement at the exchange counter. A borrower feels central bank decisions in the monthly payment. The romance of macro is panoramic. It looks at the market from the height of a watchtower. But the danger is arrogance, because from great height, even storms can look smaller than they are. Chapter 17. Quant Alpha, the Monastery of Machines. Quantitative investing replaced many old Wall Street instincts with models, data, statistics, and code. The quant does not ask the market to tell a beautiful story. He asks whether a pattern survives testing, transaction costs, regime changes, and the humiliation of out-of-sample data. Jim Simons and Renaissance Technologies became the central legend of this world. Simons, a mathematician, built a firm that recruited scientists, code breakers, mathematicians, and researchers rather than traditional stock pickers. The market became a cryptographic landscape, and price data became the encrypted message. Quant alpha often comes from many small edges rather than one grand prophecy. A tiny signal may be useless alone, but powerful when combined with thousands of observations, disciplined execution, and risk control. The romance is not in the signal, it is in the cathedral of process. But quant strategies can decay. Once a pattern is discovered, copied, crowded, or altered by market structure, its power may fade. Machines do not abolish competition, they accelerate it. The monastery of machines is therefore both sacred and restless. Its monks do not chant in Latin, they write Python, C++, and mathematical notation. They seek alpha not in a heroic opinion, but in repetition purified by doubt. Chapter 18. Alternative Data and AI. Listening to the new noise. The modern market produces more traces than any human can absorb. Satellites count cars, ships, crops, and construction. Web data tracks prices, reviews, hiring, traffic, and attention. Natural language models read filings, calls, news, and social signals at a speed that once belonged only to fantasy. Alternative data created a new version of an old dream, knowing reality before official numbers arrive. If a company says demand is strong, data may confirm or contradict it. If a supply chain slows, digital traces may whisper before the earnings call speaks. Artificial intelligence adds another layer. It can summarize, classify, detect sentiment, search patterns, and assist research. But it can also hallucinate, overfit, amplify noise, and create false confidence in elegant nonsense. The alpha source here is not AI itself. The source is better observation, better interpretation, faster synthesis, and disciplined skepticism. A weak investor with a powerful tool remains weak, while a strong process can use the tool as an extension of sight. This is the newest romance of alpha, a lantern made of data, carried into a storm of signals. The market is louder than ever, but not necessarily clearer. The future belongs not to those who hear everything, but to those who know which sounds matter. Chapter 19. Crowding. When alpha becomes fashion. Every alpha source has a life cycle. First it is hidden, then discovered, then studied, then packaged, then sold, then crowded, and sometimes finally weakened. What begins as a secret path can become a highway, and highways rarely stay quiet. Factor investing shows this beautifully. Value, momentum, quality, low volatility, carry, and other styles became academic concepts, institutional products, and portfolio building blocks. The language of alpha moved from hedge fund rooms into ETFs, pension committees, and financial platforms. This democratization has two faces. It gives ordinary investors access to ideas that were once reserved for institutions, but it also compresses the premium when too much capital chases the same pattern. Crowding is dangerous because everyone may be right in theory and wrong in timing. If many investors hold the same trade, the exit becomes narrow. The first seller may escape. The last seller may discover that liquidity was only a rumor. The tragedy of alpha is that success attracts imitation. The beautiful secret wants to remain hidden, but performance is a lantern. Once the crowd sees the light, the path changes. Chapter 20. The final map. Alpha as a living creature. The sources of alpha are not isolated islands. They overlap, argue, merge, and disguise themselves. A value trade may contain behavioral alpha. A momentum trade may contain information delay. A liquidity trade may become a macro trade during crisis. This is why investing cannot be reduced to a single magic sentence. The market is not one puzzle. It is a city of puzzles. Some doors open with patience, some with courage, some with data, some with legal expertise, some with emotional discipline, and some never open at all. The great investors and researchers did not merely seek profit. They gave names to invisible forces. Markowitz named portfolio risk. Sharpe helped name market exposure. Fama challenged the dream of easy prediction. Fama and French organized factors. Behavioral finance exposed human weakness. And quants turned noise into a scientific frontier. Yet every generation must rediscover humility. Alpha is seductive because it sounds like superiority. But the market punishes superiority that forgets risk, cost, crowding, leverage, liquidity, and time. The final truth is almost poetic. Alpha is not a treasure chest buried in one place. It is a living creature that moves when too many people approach it, changes color when regimes shift, and disappears when named too loudly. To study alpha sources is to study the market's hidden ecology. Risk feeds one species, fear feeds another, delay feeds another, and technology breeds new ones in the dark. The investor's task is not to worship any single creature, but to understand the forest in which they hunt.